Hi there, welcome to Kneppy Invest. Something a little bit different today. You'll notice no introduction or introductory slide here today. And what I'm going to talk about today is all about the contrarian trade or play. Now, I do like the contrarian play, but typically I use this in unloved sectors or commodities or themes. And typically, when you do see a sell-off in those particular areas, the areas become unloved, oversold, and the share price or the price of the commodity will go down further than it's really warranted. And sometimes you will see opportunity in those times. So I always look at commodity prices, and when something like gold is completely unloved, that is the time to take positions in those sort of areas. Now, right now, I think a possible contrarian play is tech stocks. In particular, Cathie Wood type tech stocks. Now, she's known to buy into those high growth, non-profitable sort of companies, disruptors, that sort of thing. And she believes herself that these companies are right now deep value. I probably would have to question her on that, but I am becoming a little bit interested in this space in a lot of the companies that are in her portfolios. So in this video, I am going to look at the ARK Innovation ETF, ARKK, and the reason I'm having a look at this is just where this ETF is priced compared to historical levels. And it's really interesting right now. So right on the chart here, I have the ARKK, the ARK Innovation Fund weekly chart. And we can see the share price of this ETF falling from about $160, which was reached at the beginning of 2021, all the way to a current price of $54.39. And if we look back in time to see when it was last time this ETF was trading this low, we have to go all the way back to May 2020. In fact, just prior to the COVID-19 panic or cough, the ETF actually was higher than the current price. So I think there is a possibility that the market is overreacting to this ETF, and in particular to the companies held within the ETF. So I do think there's opportunity. We've also seen a fairly big rise in volume over the past few weeks. Now, in saying that, the fall in share price of the ARK Innovation ETF has been quite dramatic over the past 4 or 5 months, falling from about $120 to $54.39. So it has dropped by more than 50% in the last 4 months. So a lot of negative sentiment in this space right now. I don't think there will be a V-shaped recovery. I probably would want to see a little bit of consolidation because we have seen a lot of people buy into this ETF at significantly higher prices. So there will be a lot of people underwater right now. And even though a lot of those investors who have bought into high prices still have a lot of faith in Cathie Wood, I think there will be some investors who have lost that faith just because the share price of this fund has fallen. So what I'm going to do in this video is I'm going to go through all the holdings, not all the holdings, probably the top 20 holdings in this particular ETF to see if there is any opportunity for us to buy individual companies, because the majority of the companies in this ETF have fallen by a significant amount over the past year. I am using TradingView in this video, not a full screen of the chart, because I'm going to look at some of the stuff that I can take advantage on the right-hand side on that column there. And I have already put in all the companies, not all the companies, top 20 or 30 companies in the ARK TF, or ARK Innovation Fund. And I'm just going to go through some of these companies, starting from the highest holdings, or largest holdings in the fund. I'm also going to look at some of the financials of these companies. So I'll just have to simple click to look at that. I'll look at revenue growth, operating cash flow, free cash flow on a quarterly basis, just to see if there is opportunity. And when I'm talking about opportunity, it's going to be a very quick look opportunity. So you want to dig a little bit deeper in some of these companies. So first company, and the largest holding in the ARK Innovation Fund, is actually Tesla. And when you look at Tesla chart, it is still moving up. Now, it has pulled back over the past 4 months from $1,240 to $801. So one of the reasons why ARK Innovation Fund has fallen by a fair bit, 50% in the past 4 months, is because of Tesla. Now, Tesla's share price has not suffered like a lot of the other companies within the ARK Innovation Fund. Now, when you look at some of their financials, so all you have to do with financial is click on this little link, more financials. I want to look at the quarterly numbers here. And the first thing I'm going to look at is total revenue. So we have quarterly numbers over the last 7 quarters. It's increased from $8 billion in revenue to $17.7 billion. And trailing 12 months, which is the last column here, so that's the last 4 months, is at $53.8 billion. So the first thing I always look at for possible investments is increasing revenue through time, and without doubt, Tesla has that. Now, the other thing I want to look at is operating cash flow, free cash flow. Cash flow from operating activities has increased through time, and in the trailing 12 months, it's $11.5 billion. So that is quite high. Now, people will describe Tesla as a tech company. It is a car manufacturing company, and car manufacturing companies spend a lot of money on capital expenditure, and Tesla is no different. There is some tech aspects to Tesla, but it is a car manufacturing, and you can see that in the trailing 12 months. They have spent $8 billion on capital expenditure, which means their free cash flow, according to this, is around $5 billion. So I wouldn't say this is completely overvalued right now. Some people do think that because this company is growing at a fairly quick rate. But, this is a huge but, there is increasing competition in this space, particularly from Volkswagen. And I think a lot of people are missing that Volkswagen eventually, I think, will overtake Tesla as one of the, if not the biggest electric vehicle manufacturing company in the world. And I think even Volkswagen have plans to become a sole electric vehicle manufacturer. I'm not sure how long that's in the pipelines, but definitely I think in the future, a lot of these competitors will just be manufacturing electric vehicles. And the other thing is, a lot of Tesla drivers who really only could buy Tesla electric vehicles have a choice now, have a wide range of choices. And I think one of Volkswagen's vehicles, which is the Audi, even the quality of the Audi has surpassed the Tesla. And I have heard that from quite a few people. So increasing competition and the very fact that Tesla's markup is significantly higher than just Volkswagen, I'd probably prefer to invest in Volkswagen over Tesla at this point in time. That's just me. Now on to the second largest company holding in ARK Innovation Fund, Roku. Now, one of the good things about TradingView, if you don't know who Roku do, I just have to move that. So Roku engages in the provision of streaming platform for televisions. That's all I know about this company. I have not looked at this company in the past at all. And when you look at the chart, the weekly chart, over the past, this goes back 3 years, right now the share price of Roku is trading around the prices we saw during the COVID-19 financial panic. In fact, it has fallen below to the share price prior to the financial panic. And the share price has fallen from $480 to current share price of $102. So the share price has almost decreased 80% over the past year. In fact, it's been less than that. We also saw a bit of a double top there as well. And the markup of this company right now is $13.8 billion. So when we saw the share price of this company reach its peak, the market cap of this company was approaching $65 million. Now let's have a look at the financial state of this company to see if this company is loss-making, that sort of thing. Unfortunately, always have to change it to quarterly. So let's just go to the income statement. First thing I want to look at is revenue. Is it growing through time? And it is growing through time. It's an increase from $356 million to $865 million, and in trailing 12 months, it's $2.8 billion. So the share price of this company right now is lower than it was prior to the COVID-19 financial panic, but revenue has increased significantly from there. So you might say this company is in better shape based off revenue growth than it was prior to the COVID-19 financial panic. Now let's have a look at cash flow. Is this company producing any cash in operations? Is it free cash flow positive? These are important things for me, and it is. In fact, in the trailing 12 months, they have produced $250 million in operating cash flow and $208 million in free cash flow. But in the last quarter, they were operating cash flow negative and free cash flow negative as well. So I think, and actually that was the first quarter in the last 7 that they were operating cash flow negative. So that could be one of the reasons why the share price has absolutely tanked for this company. Next company on the list is Teladoc, which is Teladoc. I know nothing about this company, so just push aside that. Teladoc engages in the provision of telehealth care services using a technology platform via mobile devices, the internet, video, and phone. I have not looked at this company at all. So let's have a look at the markup, $8.7 billion. Share price has fallen from the peak of around $300 to a current share price of $54.53. So it has, just like other companies within this fund, fallen off a cliff. Now let's go back in time to see the last time the share price was this low. And in fact, we have to go all the way back to the middle of 2019, so well before the COVID-19 financial panic. In fact, during the COVID-19 financial panic, Teladoc did not suffer. The share price kept on going up during that period. So let's have a look at some of the financials of this company. Why is the market really selling off of this company? Is it loss-making? So let's have a look at the income statement. Look at the quarterly data. First thing I want to look at is revenue. Revenue is growing. It's grown from 241 million to 554 million, and all that is on quarterly numbers. And trailing 12 months, 2 billion. Gross profit, 1.2 million. Net income, minus 428 million. So this company is loss-making based off the balance sheet here and the trailing 12 months. But is it cash flow positive? Is there any free cash flow? There can be significant difference between the profit and the operating cash flow and the free cash flow. So let's have a look at that. And they are operating cash flow positive, trailing 12 months, $211 million, free cash flow positive, $202 million. Now, one of the reasons why it might be unprofitable, but still operating cash flow positive, free cash flow positive, it could be just because of stock issues, that sort of thing, stock compensation. A lot of us American companies love stock compensation, I've noticed. I've only started researching American companies over the past few months, and I've noticed a lot of times they will issue a lot of stock, and that's one of the reasons they are or can be highly unprofitable, yet still be operating cash flow positive and free cash flow positive, and that is what Teladoc is doing right now. Okay, next company on the list is Zoom, and this actually company is looking really interesting right now. And of course, Zoom benefited from COVID-19, and those benefits have waned away. But I think the market is missing the story of this company. Zoom is going to stick around forever, potentially, and it could still keep on growing from here. And if we look at the chart, we can just see a massive rise in the share price from about $60 to a high of almost $600. So a tenfold increase in share price in about 9 months. And the share price then decreased from $600 all the way to a current share price of $98.97. Last time it was this high was in February, or this low was in February 2020. So that was just before the market realized this company was going to be benefiting from COVID-19. If we go back further, the share price of this company was around $100 back in June, July 2019. So I do think the market right now is overreacting to Zoom. I think it's oversold. I think there is opportunity with this company right now. You even can just look at the financials of this company. So the market cap is less than $30 billion. But when you look at some of the financials, again, we have to go to quarterly and the income statement. Revenue has grown consistently over the past 2 years. The last 3 quarters, revenue has grown at a very anemic rate from 1.02 billion, 1.05 billion to 1.7 billion or 0.7 billion. In the trailing 12 months, we're still seeing this company generate $4.1 billion, $1.4 billion of profit, and profit has increased over the last 4 quarters. In the last quarter, it was up to $490 billion of profit. So $1.4 billion of profit in the past 12 months on a market cap of 30. So even the PE of Zoom right now is looking quite attractive. And then you have a look at the cash flow. So operating cash flow, 1.6 billion in the trailing 12 months. Free cash flow, 1.5 billion. So when you look at the operating cash flow and the free cash flow, compare it to the markup, this company is looking attractive. Now, in saying that, the operating cash flow has fallen over the past 4 quarters on a consistent basis. It's fallen from 537 million to 214 million, and the free cash flow has fallen from 458 million to 193.2 million. That's why the share price of this company has fallen by a significant amount. The question is, will those falls in operating cash flow, free cash flow continue over the next few quarters? If we start to see a rise again, I think this could be a really intriguing buy. Next company is Coinbase. This has something to do with cryptocurrency. Don't know exactly what it does. Let's have a look. Coinbase operates as a secure hosted Bitcoin wallet to purchase and use Bitcoin. So something to do with Bitcoin. Now, this hasn't been on the NASDAQ for too long. We'll just have a look at the daily chart. There we go, daily chart. So when it listed, share price was around about $400. Actually, in fact, it reached a high of $430. And ever since it listed on the NASDAQ back in April last year, share price has really fallen. So it's fallen from that $400 range to a current price of $156. Go back to the weekly chart. Have a look at some of the financials. But for then, market cap 34 billion. Now let's have a look at some financials of this company to see if there is some attractiveness there. Okay, revenue growth. It is growing revenue at a significant rate. For quarter 2 2020, $186 million of revenue. In the last quarter, $2.5 billion of revenue. Trailing 12 months, 7.8. So significant increase in revenue over the past 2 years. And the company is profitable. In the last quarter, $855 million of profit. Trailing 12 months, $3.2 billion of profit. And with a markup of over 30 billion, that means the PE of this company is possibly around 10 or just above 10. Although, have to take a look at the cash flow. Is that profit of $3 billion exaggerated? Is it being increased because of one-offs, that sort of thing? So let's have a look at the cash flow from operations. In the trailing 12 months, 10.8 billion. We can see a fairly large volatility in the cash flow from operations. It went from 3.5 billion to 4 billion, down to 281 million, up to 3 billion. Trailing 12 months, 10.8 billion. Free cash flow, 10.7 million. So if you look at the profit, cash flow from operations, and also the free cash flow, this company is looking really cheap right now at these prices. So really intriguing to see how the next quarter goes for this company. So another potential buy here with Coinbase. It does look fairly cheap, but I want to research this company a little bit more to really, find out if it is cheap or if these numbers are hiding something. Maybe that's not the right way to put it, but if they're not really that high, or it shouldn't be that high anyway. Next company is, I have no idea what this company is. Exact Science Corporation. Because I have no idea what it is, thankfully in TradingView we have a brief description of what this company does. Is a cancer screening and diagnostics company. Well, diagnostics company could explain why this company has done fairly well, if it has done fairly well. The firm focuses on the early detection and prevention of some forms of cancer. This is the sort of company that I hope succeeds very well, particularly if a lot of people are saved from horrible cancer deaths. So, Exact Science Corporation. The chart doesn't look horrible, not as bad as some of the other companies, but share price of this company has fallen from $160 to just less than $60 over the past, actually this is the weekly chart, yeah, so over the past year it has fallen from $160 to $60. So not bad looking chart, but share price is getting towards the lows we did see during the COVID-19 financial panic, just like a lot of other companies in this list. So let's have a look at the markup, 10.2 billion. So is that high or low? Well, let's have a look at some of the financials. Quarterly income statement. Revenues. Well, we don't see significant growth in revenues looking at it quarter on quarter. So revenue has grown from 269 million to 474 4 million, but over the past 6 quarters, it's been the $400 million to $500 million range. So no significant increase in revenue. Looking at quarter on quarter over the last 6 quarters, trailing 12 months, $1.8 billion of revenue, and the company is not profitable. They are loss-making. In the trailing 12 months, they did lose $600 million. But again, just because they are loss-making doesn't mean they don't generate cash in operations. So let's have a look at that. And this company is not generating cash in operations. In fact, in the trailing 12 months, they did lose $86 million and free cash flow negative of $221 million. So this is the sort of company I'd probably leave on the sidelines just to see if they can become operating cash flow positive on a consistent basis and then free cash flow positive on a consistent basis. So I'd probably leave this company onto the side and really wouldn't even think about investing in this company just at this point in time. Next one is Square, and hopefully, that's not Square, Block. Just have the ticker code SQ. And this was called Square at one point, and they changed the name to Block, if I remember correctly. Anyway, Australian investors should know a little bit about this company because they bought out Afterpay, and they actually are listed on the ASX right now. And just like every other company in this ETF, the share price has fallen a fair bit over the past few months, even over the past year. Share price of Square has fallen, or Block has fallen from $290 to current share price of $103. Markup is $59.8 billion. The share price is still above pre-COVID levels. We did see a share price of this company get up to around about $100 in late 2018, just before we did see a share price pull back during that period because of threat of rising interest rates. So it's interesting to see the share price almost at the same level to what it was back then. So there could be some value with this company right now. Next thing I just want to do here is look at some of the financials, quarterly overview, income statement. Are we seeing revenue increase through time? And we are. It's increased from 1.9 billion to 4 billion. Now, we have seen the revenue as high as 5 billion in the first quarter of 2021 and has actually decreased. But in trailing 12 months, $17.7 billion has profitable, not profitable on a consistent basis when you look at quarterlies. In fact, the last quarter they were unprofitable by 77 million, but trailing 12 months profitable by 166.3 billion. Let's look at the cash flow. Cash flow positive on a fairly consistent basis, but there has been quarters here where they're actually operating cash flow negative. The last 3 quarters, highly operating cash flow positive, and the trailing 12 months, almost operating cash flow positive by about $1 billion and free cash flow positive about $700 million. Things to like about Block, things to not like about Block. I think there is a little bit of, I won't say overvaluation when it comes to this company, but I would like to see better financial numbers. So you can just see this little graph here, this income statement. We have seen these blue bars go down over the last 4 quarters, and that's the one concerning thing about Block for me. Next company is Unity Software. Again, I don't know a lot about this company. I do know it's a fairly popular company. So Unity Software develops video gaming software, provides software solutions to create, run, and monetize interactive, real-time 2D and 3D content for mobile phones, tablets, PCs, consoles, etc. It doesn't look like it's been listed on the NASDAQ, or not NASDAQ, NYSE for too long. So listed in around September 2020 at about $70. Share price went all the way up to $210 and has pulled back all the way back to $77, so almost to the IPO price. So interesting chart here. And then, of course, the next thing we have to look at is markup, $22.7 billion of markup, and then have a look at the financials. Is this company profitable? Is this company producing cash in operations? Revenue has grown pretty good from 184 billion to 316 million, $1.1 billion in trailing 12 months. Company is not profitable. In fact, the losses of this company increase quarter on quarter. So it's increased from 27 billion loss to 162 billion loss in the most recent quarter. In the trailing 12 months, a loss of 533 billion. But again, they could be issuing a lot of shares for compensation. So let's have a look at the cash flow of the company. Cash from operating activities. Well, not too bad. There has been some quarters where they're operating cash flow positive, some quarters where they're operating cash flow negative. Trailing 12 months, operating cash flow negative 85 billion and free cash flow negative 127 billion. So just like a couple of other companies in this list, I'd probably put this onto the sidelines. Just wait and see if they can continue to grow in the future, if they can become operating cash flow positive, free cash flow positive, because right now, quite negative sentiment in this company. So this is one of these other companies I just leave on the sidelines. I think the other company that fit into that category was Exact Sciences there. Twilio. I know a lot of people love this company. This has something to do with engages in the development of communication software, cloud-based platform and services. Its products include Twilio Flex messaging, programming, voices. I think someone was telling me that when you go to Uber, or so, I don't know what they do. Someone was trying to describe me exactly what Twilio does. So it's sort of everyday use, that sort of thing, but I can't explain it right now. So I don't really follow this company too closely. Share price has cratered, just like many other companies, falling from $460 to $128.93. Last time it was this low was way back in April or May 2020. Share price got as low as about $80 during the COVID-19 financial panic. The share price is now lower than pre-COVID levels. If we go back to 2019, share price of this company was higher. Market cap of Twilio is 22.7 billion. So let's have a look at some of the financials of this company. And if I like what I see, maybe I'll do a little bit more research on this company. So yes, a lot of these companies I have not looked at in the past. So this is the first time I've looked at these companies in this video. So I just want to look at the quarterly data. Revenue, has revenue grown? Revenue has doubled over the past 6 quarters. Is it 6 quarters, 7 quarters? Revenue has doubled from 408 million to 843 million, trailing 12 months, 2.8 billion. So revenue is growing. That is important. I want to see revenue growing. Is this company profitable? No, it's loss-making on every single quarter. Not only is it loss-making, it's loss-making, or the losses are increasing through time, and that's not a good sign. So it's increased from $100 million loss in quarter 2 2020 to almost $300 million loss in the last quarter, and in the trailing 12 months, almost a $1 billion loss. I don't like that, but again, there could be some reasons behind it. So let's have a look at the cash flow. Operating cash flow negative by a small amount the last 2 quarters. They were actually operating cash flow positive in the first 2 quarters of the financial year. Overall, operating cash flow negative by $9 million, free cash flow negative by $99 million. Changes in working capital, $136 million negative. So not the greatest financial data or look for this company, particularly the loss-making. But the one really good thing about this company is that growth in revenue. They have double revenue. And that's one of the reasons why there's a lot of hype, or has been a lot of hype in this company, is just because some people out there, some investors just look at the revenue growth and they don't look at anything else. You have to look at the whole picture here. And right now, I don't think this is the highest quality company in this particular list. So next company on the list is Path, which I have no idea, UiPath. No idea what this company does. Hasn't been listed long on the NYSE, New York Stock Exchange, and it has been doing horribly since it listed. You just look at the chart there. So UiPath engages in the development and provision of a software platform to automate business processes. It serves the public, healthcare, telecommunication, finance, and banking industries. I still have no idea what it does. That's not the best description. So look at the daily chart here, and the share price has just fallen from when it IPO'd. It did reach a high of about $90 just after it IPO'd back in late May 2021, but has fallen from that $90 all the way to a current share price of $24.89. We'll go back to the weekly chart. The market cap of this company is $12.9 billion, so you want this company to be significant growth in revenue, hopefully operating cash flow positive, free cash flow positive. So let's have a look at some of the financial data of this company. Quarterly income statement. Revenue has almost doubled over the past 6 or 7 quarters, from 113 million to 221 million. Trailing 12 months, 810 million. So first step is a good step. We want to see revenue growing through time. Is this company profitable or is it loss-making? And unfortunately, it is loss-making. And over the trailing 12 months, a loss of $436 million. That doesn't tell us the whole story. We have to dig a little bit deeper. And the most I want to dig a little bit deeper is just looking at the cash flow statement. Cash from operating activities. The last 3 quarters, we only have 3 quarters of history here because it's only been listed on the New York Stock Exchange for 3 quarters or so. I don't know. Anyway, only 3 quarters of history here. Operating cash flow negative and free cash flow negative as well. So again, this is another one of those companies that I just want to push aside, leave it on the sidelines now, wait until I see some verification that this company has made it. Revenue growth is not verification or confirmation that this company is a legitimate company and can become profitable in the future. I need to see some other signs in regards to that. Spotify. So most people know what Spotify is, so I won't have to tell you what this company does. Now, it has gone through some issues because of that podcast, or whatever that podcast is, and a lot of musicians didn't like, was it Josh Rogan or something like that, and people don't like that he's an idiot and don't want their music on this platform because they sort of market him or pay for him, I don't know. Anyway, so we have seen the share price struggle over the past few months. In fact, share price has fallen from a high of $390 to a current share price of $124. Let's go back through time. The last time share price was this low was at the depths of the COVID-19 financial panic. In fact, if the share price of this company falls another $20 odd, it would be an all-time low for Spotify, and this could be an intriguing buy, possibly. Market cap of Spotify is $22.6 billion. I'll have a quick look at the financials. So this is looking a little bit intriguing. Income statement, revenue has grown, not quickly. So it's only grown from 2.1 billion to 3.1 billion over the past 7 quarters. Trailing 12 months, 11.4 billion. Let's look at the profitability of this company. And it is mostly loss-making when you look at quarter on quarter. And over the trailing 12 months, loss-making of 38.6 billion. There could be many reasons for that. You can see a lot of volatility in the net income when you look at the quarterly data. In fact, there's one quarter they were loss-making of 392 million. Another quarter they were profitable, 27.8 million. So let's have a look at the cash flow. Cash flow from operating activities. This company is consistently operating cash flow positive, ranging from 65 million to a high of 147.9 million. In the trailing 12 months, operating cash flow positive, 421.3 million. And are they free cash flow positive? Yes, they are, 324 million. So I think this company I need to do a little bit more research on this company. So where is this cash going to? Why are they unprofitable? Are they spending a lot of money on research and development? That sort of thing. So a lot more research needed on Spotify, but I do think this company is starting to look more attractive just because of this negative sentiment in this company. I think this could be a contrarian play in the future, even right now. Next one is CRISPR. Now, I have heard about this company. So this has something to do with genetics or gene splicing, who knows. So CRISPR operates as a gene editing company. The firm focuses on developing transformative gene-based medicines for serious diseases using its proprietary CRISPR-Cas9 platform. So probably another company you want to succeed in the future, but just because you want a company to succeed in the future doesn't mean it will. Let's have a look at the share price. Well, just like every other company in this list, the share price has absolutely tanked. That's not absolutely true because Tesla hasn't tanked. Anyway, CRISPR has fallen from $220 to a current share price of $60. And the last time it was this low was again during the COVID-19 financial panic, or just after that anyway. And the share price actually has been higher than this. Prior to that, in 2018, the share price was higher. So it's been 3 years, actually almost 4 years since then. So this company should be a better company now. So there might be good value in this company at current valuations, depending how they have done financially. So the market cap of CRISPR, $4.5 billion. Doesn't seem too high. There must be some reasons why. I have a feeling if we look at the financials, probably not the best looking financials when you look at this company. So revenue has grown from $44,000 to $12.9 million. So $914 million in the trailing 12 months. So there was one quarter where they received $900 million of revenue. So revenue is a major issue with CRISPR. So I think the potential of this company is just, well, it's all that. It's just potential. So that's probably why Cathie Wood has invested in this company, is just the potential in the future. I have no idea how you value potential. You can get completely different ranges of valuations based off how you view the potential of this company. So right now, revenue is a concern just because it's so volatile, and more than likely this company is loss-making. Well, most quarters it is loss-making. There was that one quarter where they received $900 million of revenue. In fact, they were profitable in that quarter by $759 million. So let's have a look at the cash flow. This probably is a little bit different. Yeah, most quarters this company is operating cash flow positive. There's just one really good quarter. And the reasons why that quarter was really good was probably because of one-off payment, something like that. And I do think you have to take that into account when you are judging these sort of companies. So CRISPR, probably will have to do a little bit more research on what they do, where the potential is in this company. But there is possible potential. I just don't know with CRISPR. Intellia Therapeutics. Again, another one of these companies I know nothing about. Markup $4.4 billion. Share price. This is one of those companies where during the COVID-19 financial panic, this company did nothing. Share price has increased from about $10 to a high of $180. What an absolute wealth winner for shareholders during that period. Significant increase in share price, 18-fold increase. The share price has pulled out from a high of $180 to current share price of $58.27. I have no idea what this company does, so let's have a look. What Intellia Therapeutics does is a clinical stage genome editing company which engages in the development of curative therapeutics using the CRISPR Cas9 system. So this company is related to CRISPR. So Cathie Wood probably likes CRISPR and this Cas9 system. She thinks it is going to be transformative in health in the future. So she's put all her eggs in the one basket, more than likely. I probably would suggest when we look at the financials of this company, it's not going to be too exciting. So let's look at the revenue. Well, $33 million of revenue in the trailing 12 months, loss making $269 million. So again, this is a company that's all about the potential, and you have to know about the potential. And I think you do have to be quite bullish about the potential of this company. More than likely, not a lot of cash flow. In fact, trailing 12 months, operating cash flow negative by $216 million. Free cash flow negative, $229 million. I have no interest in this company at all at this point in time. Cathie Wood will probably disagree with me, but that's the whole point of investing. You can have different opinions of other investors out there. Next company, Beam Therapeutics. This could be a sort of a similar theme. So let's have a look at what Beam Therapeutics does. If it is into CRISPR-9 stuff, well, Beam Therapeutics develops and commercializes DNA-based editing technologies for the treatment of human disease. It does sound fairly similar to CRISPR and the previous company, which I've already forgotten what the name is. So Beam Therapeutics has a markup of $3.7 billion. Share price has fallen. You can see a significant run in the share price during 2020 and in the start of 2021. This company listed just before the COVID-19 financial panic. Share price at that point in time was around $16. Share price reached a high of about $140 in around about May of last year and has fallen back to $55.24. I probably would think this company does not have much revenue or cash flow, so let's have a look and confirmation behind that. Revenue, well, it's increased in the last quarter, so $763,000 in the third quarter, $51 million in quarter four. That's a significant increase in revenue quarter on quarter there. But is that a one-off? Is that going to continue in the future? If that sort of growth can continue, this company would be one of the biggest or highest growing revenue companies in the world. Net income, so unprofitable by $371 million in the trailing 12 months. And more than likely cash flow operating. So even though they had significant revenue in the last quarter, there was no cash flow. Very small cash flow, only $1 million of cash flow in the last quarter, and they were free cash flow negative by $12.6 $3.4 million. This is another one of these companies in Kathy Wood's fund that I really would like to see some success, some evidence that this company is the future, that the potential of this company is realized. I'd like to just stay on the sidelines with this other company. Next company is Shopify. Hopefully most people know what Shopify is, but I have been starting to pay attention to this company. Not only Shopify, but also the Mercado Libre one, which is a South American Amazon. I think if the share price falls in Amazon, that could be looking more attractive. So Shopify is starting to look more and more attractive. When you look at the share price right now at $550, it did reach $550 just prior to the COVID-19 financial panic and fell all the way to $300 during the panic. So the share price of this company is right now at the same level prior to the COVID-19. So that is one of the reasons why this company is looking a little bit more attractive. Market, $69.7 billion. So let's have a look at the financials, and I think there will be some attractiveness when we look at some of the financial numbers. So income statement, revenue has grown from $714 million to $1.4 billion. So it's almost doubled in the past 7 quarters, $4.6 billion in the trailing 12 months. Not profitable in the last quarter, but it was profitable in the 3 previous quarters, and in the trailing 12 months, $2.9 billion of profit. If they can keep that going, I think this company will grow quite considerably in the next 5 to 10 years. So I think there is potential value with Shopify right now. Cash flow, operating cash flow positive, $258.8 million in the last quarter, $502 million in the trailing 12 months. Free cash flow positive, $451 million. So again, this company is free cash flow positive, operating cash flow positive, profitable. The share price has plunged, the valuation has plunged. The question is whether the valuation of around $60 million or $60 billion is good value at these current times. And that's probably the only question I have right now with Shopify. Is there good value with the company right now? I think it is starting to look more and more attractive. Only 5 companies to go. Next one is a betting company, Draftkings. I think this is a betting company. That's just confirmed. And betting companies are all the rage, or have been all the rage, or were all the rage. So DraftKings operates as a digital sports entertainment and gaming company, probably a little bit more involved than some of the other companies. But DraftKings has a valuation of $6.6 billion. And just like other gaming companies, particularly on the ASX that I know, PointsBet, what's the other one? PointsBet. There's other companies there. A lot of those companies' valuation has fallen a fair bit over the past few months. DraftKings is no different. Share price has gone from $64 to $16. So that's a 75% decrease in the share price. And just like a few other companies on this list, the share price of DraftKings right now is actually lower than it was prior to the COVID-19 financial panic. Let's have a look at the financials. I don't think this is going to look good because a lot of the other betting companies' financials don't look good at all because they're spending a lot of money, because betting is opening up in America and it's just like a land grab. They want to get as much business as possible, force out some of their competitors eventually, and to do that, they have to spend a lot of money. So let's just have a look at DraftKings is doing that. Look at the quarterly numbers. Revenue has exploded, increasing from $71 million to $473 million. In fact, it doubled in the most recent quarter, and in the trailing 12 months, $1.3 billion. But they are spending a lot of money, and they are loss-making. In fact, in the trailing 12 months, they did lose $1.5 billion, which is more than the revenue they made. Now, that does not equate to this company bleeding cash, so we have to have a look at the cash flow statement. Cash flow from operating activities, negative $418 million. Free cash flow, negative $434 million. And just like I thought, this company is spending a lot of money to get as many customers as possible, as all the as all the betting become legal. So betting is becoming legal state by state. It used to be mostly illegal in most states, apart from Las Vegas, not Las Vegas, that's a city, apart from Nevada. But betting is starting to open up all around the country over there, and that's why a lot of these companies are spending a lot of money. So I keep DraftKings on my watch list. That's about it. Fourth last company is Robinhood. Not sure why Cathie Wood invested in this company. It's been a disaster since they listed. 1 week after they listed, the share price did increase to a high of $85. Current share price is $11. So a significant decrease in share price since this company listed. Robinhood, markup $9.6 billion. Too much hype in this company, if you ask me. So even share price of $11 might not be attractive enough for me. So let's have a look at the financials. I would not be surprised if this company is burning through heaps of cash. Revenues climbed from $244 million to $369 million. So not a significant increase in revenue. So $1.8 billion in the trailing 12 months. Loss making, that's pretty high, $3.7 billion of loss, and it's on a consistent basis over the past 4 quarters. If you go back 5 quarters ago, they actually made a profit of $13 million in the 4th quarter of 2020. So why has this company just gone from being profitable in 1 quarter to significantly loss-making in the last 4 quarters? I don't know. Probably do a little bit more research on the reasons why. So let's have a look at the operating cash flow. Well, in the 2nd quarter of 2021, they were operating cash flow positive $1.9 billion. Now they're operating cash flow negative in the trailing 12 months, $2.6 billion. So why was that 1 quarter so highly operating cash flow positive when every other quarter was highly operating cash flow negative and free cash flow negative, $2.7 billion? I would not even look at touching this company right now based off these or some of these financials, and that's why the share price of this company has absolutely tanked. Again, I'm not sure why Cathie Wood thought this company was a good investment. Third last company is PagerDuty. No idea what this company does. Let's have a look. PagerDuty operates a digital operations management platform. It provides incident management solution that integrates with information technology, ops and DevOps monitoring stacks to improve whatever. That doesn't really tell me what this company does. Markup of PagerDuty, $2 billion, so fairly small company. Share price has just really done nothing. It's just gone sideways since this company listed back in 2019. Share price reached a low during the COVID-19 financial panic of $14, reached a high of $58, and the beginning of 2021 has pulled back to $25. Let's have a look at the financials of this company. Is there going to be anything interested in revenue growth, operating cash flow, that sort of thing? First thing I always want to see is some good revenue growth. And if you look at the quarter on quarter, it is growing at a slow rate from $50 million to $71.8 million. Trailing 12 months, $262.2 million. So nothing really exciting about the revenue growth, if you ask me. And unprofitable in the trailing 12 months, $100 million. And it's fairly consistent. So if you look at the last 5 quarters, unprofitable by $21 million, $22 million, $22.6 million, $30 million, and $26.3 million. Slowly increasing loss quarter on quarter. So nothing too exciting with PagerDuty just yet. Let's have a look at the cash flow. Any cash flow with this company? Yes, there is. So this company is producing some cash flow in operations, not consistently, and it is fairly low. And when you look at the trailing 12 months, only $1 million in cash flow, free cash flow negative by $4.6 million. So at this point in time, not that interested in PagerDuty. There is a slow increase in revenue, but I would prefer that to be a little bit more. And if they have that slow growth in revenue, I prefer this company to be profitable and generating more cash in operations than what they're doing. So not interested in PagerDuty whatsoever. Fate. What is Fate? Fate Therapeutics. Now, one of these therapeutics companies. What do they do? More than likely, it's going to be something to do with gene editing or something. Let's have a look. Engages in the development of programmed cellular immunotherapy, for cancer and immune disorder. Its pipeline of products includes immuno-oncology candidates. I don't really care. Okay. More than likely, this company is not generating any money whatsoever. Markup $2.9 billion. Before I go there, let's have a look at the chart. I totally forgot. So the share price went from $16 to a high of $120. So that's from the low of the COVID-19 financial panic to the high at the start of 2021. The share price has fallen from $120 to a current share price of $31, just like many other companies in Cathie Wood's innovation fund. The share price has absolutely tanked. Now let's have a look at the financials. Is Cathie Wood's too high on potential of this company? I'm not really big on these therapeutics companies. I think Cathie Wood has just too much optimism about the future success of these companies. So let's have a look at the income statement on the quarterly basis. Is this company generating any revenue? It is actually generating revenue, and revenue has climbed through time, but it's small. Increased from 5.5 million to 17.1 million in the trailing 12 months, 55.6 million or 55.9 million. And unfortunately, it is fairly small revenue, and this company is spending a lot of money. We know it's spending a lot of money because it is loss-making in the trailing 12 months by $212 million. I don't like that at all. Let's have a look at the cash flow. Maybe there's some better signs in cash flow. No, this company is bleeding a lot of cash. $163 million in negative cash flow in the past 12 months. And the worst month or worst quarter was the most recent quarter, where they burned through $70 million of cash and free cash flow negative of $214 million. So Cathie Wood obviously sees something in this company. And to be honest with you, I just don't really care about researching these sort of companies. I want to see some proof that this company can generate cash, can become profitable. I'd leave all the risk-taking to Cathie Wood and investors like that. And the last company in this list is Signify Health. It's not the last company in Cathie Wood's fund. There's about 10 to 15 more companies, but I thought I'd just leave it here. Signify Health. This company hasn't been listed long, and when it IPO'd, that was almost the share price high. It reached a high of about $41. The current share price is $16. It does look like there's been a nice rebound in the share price over the past 6 weeks to 2 months. Share price has increased from $11 to $16.26. Nice volume as well. So something positive might have happened with this company, Signify Health. Let's see what they do. Signify Health is a healthcare platform that leverages advanced analytics technology and nationwide healthcare provider networks to create and power value-based payment programs. Whatever. Anyway, so the most important thing here is the share price has fallen a fair bit since the IPO. Market cap is $3.6 billion. Does this company generate any profit, any cash flow in the operations? Let's have a look. First thing we want to do, again, is this company producing any revenue, and is that revenue growing? Well, the revenue is growing, 131 million to 181 million. So not significant growth in revenue. In fact, the last 3 quarters revenue has gone backwards from 213 million to 181 million. Trailing 12 months, revenue of 773 million. Now, so this company is growing revenue, does have revenue, some good revenue. Is it profitable? Well, in the trailing 12 months, it was profitable by $20 million. On a quarter-by-quarter basis, it's up and down there, but no massive loss-making quarters, no massive profit-making quarters. The last 2 quarters, they were profitable by $20 million and $22.7 million. Let's have a look at the cash flow, see if there's anything different there. Cash flow from operating activities, cash flow positive, $130 million. Now, a little bit more volatility when it comes to operating cash flow. We have seen it as high as $87 million and as low as negative $21 million, and free cash flow positive, $101 million. And just like operating cash flow, there is a little bit of volatility there. So fairly high cash flow in one quarter, fairly low of free cash flow in the next quarter. So at this point in time, no interest in this company at this point in time. So quite a few companies in the ARK fund that I'm not really interested at all. There are a few companies that I am looking at. Zoom and Spotify are the main ones. I do think there is potential opportunities in those 2 particular companies. Otherwise, I'm staying well clear of most of these companies. That's all I have for this video on looking at ARK Innovation Fund and some of the constituents and holdings within the fund, because right now, with the share price of this ETF and a lot of the share prices of the companies within the ETF falling by a significant amount, upwards of 80% over the past year, I think this could be a contrarian play, and particularly a few companies in this fund I do like, potentially. Zoom and Spotify are the main two ones. If you want to leave your thoughts about anything I discussed in this video, just leave a comment in the comment section of this video. If you have any questions, do likewise. Otherwise, I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a great day. Bye.